What's up, everybody? Welcome back to Brofolio. After feeling the pressure of having his portfolio down 2 days in a row, President Trump announced he is delaying a planned military attack on Iran that was scheduled for tomorrow, which caused the market to recover $500 billion in stock losses today. Treasury Secretary Buffett extends Russian oil sanctions relief for another 30 days. Seagate told a JP Morgan conference that new memory chip factories take too long. And Bill Gates Foundation officially holds 0 shares of Microsoft for the first time since the year 2000. Thank you for tuning in. Let's break it all down. First on the clock, the bond market is the story even when it isn't the headline. The 10-year Treasury yield closed today around 4.63%. That is the highest level since January 2025, and the 30-year is now sitting around 5.15, which is a level we haven't seen since 2007. CME FedWatch now shows a 45% probability of a Fed rate hike before year-end. 1 month ago, that number was 1%. The market has gone from pricing the Fed to do nothing for months to now pricing in potential hikes in 30 days. On Friday last, the market had its worst session in weeks, and it came on the heels of a fresh all-time high on Thursday. The S&P shed 1.24%, the Nasdaq dropped 1.54%, the Dow lost 537 points. Today, the Dow scratched out a small green, the S&P closed flat, the Nasdaq closed red for a second straight session. For most of the day today, it looked like we had another chance of having a similar down day like Friday. But then Trump tweeted about not attacking Iran tomorrow, and it recovered most of its losses. This was a perfect example of the headline-driven market we are currently in. Iran negotiation news can trigger instant risk-on or off events, but the real test is whether oil... Now moving on to the oil news. Because the supply story is getting messier every day, today Treasury Secretary Scott Bessent announced the U.S. is extending the sanctions waiver on Russian oil for another 30 days. This is now the second formal extension of what was originally framed as a one-time emergency measure back in March. The framing today was that this provides relief to energy-vulnerable countries. The real story is that with Hormuz disrupted and Saudi output sitting at a 35-year low, the United States is now quietly putting Russian oil back on the market to keep gasoline prices from even more parabolic than they are currently. Additionally, the Strategic Petroleum Reserve now sits around 414 million barrels, which is the lowest level since the 1980s. We are using records amount during what the administration insists is a manageable conflict. In March, they released the largest single-country emergency release in history, 172 million barrels. Sanctions getting unsanctioned, emergency reserves getting drained, and oil is still continuing to crawl higher. The policy tools that are designed for emergencies are becoming routine measures, and the policies are admitting something the rhetoric is not. Moving on to the AI news. The story under the surface was memory chips. At a JP Morgan conference today, Seagate's CEO said that new factories take too long to build, which the market read as an admission that the memory chip industry cannot meet AI demand. This caused Seagate fell nearly 7%, Micron dropped 6%, and Nvidia and Broadcom got dragged lower with them. Semis are the market. Over the past year, the Philadelphia Semiconductor Index is up 143%. The S&P 500 Equal Weight Index is up 15%. SOX is trading 32% above its own 50-day moving average. That kind of extension is historically rare and historically followed by mean reversion. And the leverage in the system is sitting at all-time records going into this. Margin debt and leveraged ETF positioning are at all-time highs. When a market this concentrated and this leveraged gets a multi-percent reversal in the leaders, the unwind will feed itself. Nvidia reports earnings Wednesday after the close. That print is going to decide whether last week was... Now moving to the global markets, because the foreign desks are starting to tell a crazy story. Foreign central banks have been diversifying out of U.S. treasuries. Japan still holds about 1.24 trillion, the UK at 897 billion, China at 693 billion. But the composition is shifting at this exact moment. Yields rising at the long end is the bond market pricing that change in real time, which is not a good time for the US due to its needs to fund a war and refinance trillions of dollars of debt, now at higher rates. On Friday, the Kospi opened the session and touched 8,047 intraday, the first time in history any Korean index hit that level. Then in the same session, it reversed and closed down 6.12% at 74.93. 6%! After an all-time high, in one session. The Korean market is up over 80% year to date, driven almost entirely on the AI memory boom. Samsung and SK Hynix make up roughly 42% of the entire Kospi weight. When they sneeze, the whole market feels it. Korean retail investors net bought roughly $5 billion on Friday, the largest single-day retail purchase in Korean stock market history. Foreign investors had net sold 26.4 trillion won from May 7th through the 14th. While the retail crowd was buying the rip, they also poured 34.4 trillion won into a 2 times leveraged inverse ETF during the same run-up. Leveraged long the index on one side, and piling on top of that, China signaled last week that it is no longer interested in US semiconductor purchases at scale. The China AI chip thesis just got a cold splash of water. What this looks like is every parabolic top in market history. And before we close, 4 pieces worth flagging. First, China is building nuclear reactors at a pace the United States physically cannot match. Beijing has approved 10 or more new reactors every year since 2022. 38 units are under construction right now. The plan is to start 8 to 10 new units per year going forward. The energy story of the next decade is not lithium, it is uranium and the build-out of stable baseload to feed AI compute. China understands this, and the US is falling behind on this. Second, Japan. The 30-year JGB has now sold off to levels that have a very specific historical analog, and it is not a comforting one. The last time long-end Japanese yields moved like this, the global carry trade started to unwind. We are watching that movie play out again in real time. And the punchline on sovereign debt, it does not matter until it matters. When it matters all at once. Third, Berkshire Hathaway is now sitting on roughly $397 billion in cash and short-term treasuries. That is up from $373 billion at the end of last year. 14 straight quarters of net stock sales. The most patient capital on the planet is sitting on the sidelines hoarding cash at the exact moment retail is taking out margin to chase semis. And finally, Bill Gates Foundation disclosed in a 13F filing Friday that it sold its final 7.7 million Microsoft shares, about $3.2 billion. The foundation went from 28.5 million shares to 0 in 2 years. So here is the bottom line. Last week, the indexes printed new all-time highs Thursday and lost most of those gains by Friday's close. Today, the bond market kept going where the stock market refused to. 10-year yields at the highest in over a year, 45% odds of a rate hike. Oil topping 110 before pulling back on a Trump tweet. The smart money sitting in cash, the retail crowd, here and in Korea, leveraged on both sides of the trade. Wednesday after the close, Nvidia earnings. That is the print that decides whether last week was just a wobble or the start of something more serious. Walmart and Target also report this week, which will tell you what consumer spending actually looks like at these oil prices. That's the tape. Thank you for watching. Make sure to like, comment, and subscribe. Catch you tomorrow.